Hello and welcome to this special Year Ahead edition of On Point, a podcast series where we explore the post-pandemic economy and the biggest themes and events shaping the outlook in 2022. I'm Imogen Bachra, European rate strategist at NatWest Markets, and I'm joined today by Ross Walker, Kevin Cummins and Giovanni Zanni, our team of economists, to talk about savings and a role that they might play in the recovery. Savings have increased a lot during the pandemic, in part because people just couldn't spend. And now that things are normalizing, it's assumed that saving behaviors will normalize too. So Giovanni, we see a lot about the potential for savings boosting demand in a lot of official speeches, but what are we really talking about in terms of the size? How much could this actually boost GDP growth, and over what period are we thinking about this?
Thanks, Imogen. Well, I certainly agree with the idea that the saving dynamics are a key feature of any projections of activity over the next 2 or 3 years, let's say. And to define the impact, the size of the potential impact and the timing, I think we need to distinguish between two different FX impacts of the savings dynamics. The first one is the flow. And by that, I mean the fact that the saving rate out of household income is still very high. So the normalization of this rate from current levels to the steady state level will by itself already boost GDP and consumption by quite a lot. And this is happening relatively fast. I mean, in the US is quite advanced. For the euro area, we're still a little bit behind, but I think that in the course of 2022, so over the next year or so, we will have the biggest normalization on that side. And if you look at the numbers of the saving rate right now and what is the steady state, we're talking about between 5 and 6 points of consumption to be added, let's say, over the next year or so. The other impact, which is the stock, what I call the stock effect, which is basically what is going to happen to the stock of excess savings that has been accumulated during the pandemic. How this is going to be used, spent, the timing, it's much more controversial. At the beginning of the pandemic, there were studies suggesting that it could be very small, below 5%, or up to 40%. Since then, we had a lot of surveys discussing and looking and asking questions in a lot of different jurisdictions, and we came to something that was close to 20%, 30% as a benchmark. And the amount of savings, for example, again, the euro area, my colleagues will talk about the other areas as well, but for the euro area, this is worth 10 percentage point of household income again. So if you take 20% of that, it's another 2 percentage points over the next, let's say, 2 or 3 years will be my estimate. So if you combine the two, you have around, let's say, 8 points of consumption to be added to the normal dynamics of consumption growth, etc., with the biggest impact, I would say, next year, and with also remaining impact in 2023 and maybe 2024.
What about in the US then, Kevin? Is that, are we expecting a similar impact over a similar time frame?
Yeah, the recovery in the U.S. has been a little quicker as far as the snapback in activity amongst consumers. We saw a really strong growth rate in the second quarter. As far as what Giovanni correctly pointed out with regard to the current level of savings in the U.S. is running right around 9% as of the third quarter of this year. And just to put that into a frame of reference, pre-COVID, the longer run trend in the saving rate was around 7% or so. So, I think in the fourth quarter heading into COVID, you were at like 7.25%. So you're almost about 2 percentage points still above where you were in the longer run trend there. So, excess savings is probably somewhere north of $2 trillion here in the U.S. As long as that saving rate is remaining above the long run trend, that's continuing to move higher. And if you even add in, capital gains, it's probably a significant amount more. So I think, that their households are in a very strong position to continue to spend for a substantial amount of time here in the U.S., even though we saw a lot of the saving rate come back down. It was as high as the mid-20s as far as a percentage of disposable income. So, I think it's right. I think it's fair, and it's a reasonable assumption to think that, the saving rate coming down into 2022 is likely. So we have very strong consumption growth into early next year of about 3.5% top line GDP and consumption. So, it certainly seems like the flow effect is the, as Gio pointed out, not very controversial. The stock effect, that's as he said, suggested some of the survey data weren't suggesting that dramatic of an increase for the U.S. Like, for example, the New York Fed came out with a survey saying about 25% of the economic payments potentially could get spent based on a survey they said. But, I'd point out that so much of this was forced savings, and that, as things begin to, move into next year and we move past COVID, hopefully, there's a lot of pent up demand and a lot of pent up, things on travel and food services and in-person services that are likely to get spent. And, if you look at the percentage of consumption right now versus where it was pre-pandemic, you're about 9% or so above where you were back in the fourth quarter of 19. But most of that is all in goods consumption, about 25% increase, and services is only a little bit above 3.5%. So I think that's where we're going to see most of the spending is on the service side in the US.
What about in the UK then, Ross? Is there a distinction to be made there about the kind of distribution of savings that we see and the ways in which that might be spent down?
So the savings data in the UK in aggregate are very similar to the numbers Kevin and Giovanni were discussing for the US and Euro area. We estimate that the excess household savings stock is around £150 billion, close to 10% of household disposable income. But of course, the key feature is the highly uneven distribution of that saving. For that, we rely on some survey data. What the surveys tend to show is that if you take the bottom fifth of households, the lowest income group, probably their net savings have fallen during the pandemic. For the second lowest income group, savings overall appear to be flat during the pandemic. But that means that probably about 2/3 of UK households have seen some increase in their stock of saving money sitting in bank accounts. And we estimate that for the median income UK household, that figure is probably in the region of £1,000 or even £2,000 of additional savings. So whilst that may not be deployed immediately, providing an upfront boost to household consumption, it does tend to strengthen our confidence that the sustainability of the recovery and consumer demand can continue, that this will provide an ongoing support for UK households in the face of what in the coming year will be a significant squeeze on real disposable income in the face of rising inflation, tax rises, and of course interest rate rises in the UK.
That brings me nicely on to my next question then for you, Giovanni, that we hear a lot about this kind of apparent fiscal cliff that's waiting for us after this kind of pandemic binge, if you like, on fiscal policy. Is this something that we should be worried about? I guess the key question, well, for this whole podcast really is, can we be saved by savings?
Yeah, I mean, I think we can. And I'll explain actually before talking about the savings compensation for the fiscal cliff. I'd like to, define a bit more what you said in terms of apparent fiscal cliff, because what we need to say first is that when you look at the usual fiscal metrics, it seems that we are reducing the fiscal support quite a lot from 2022. After the big binge of 2020 and 2021. In reality, some of that reduction is mechanical in the sense that it's not real, just because the normal activity replaces what was the support of the government of public spending. Doesn't mean that we are talking about subtracting resources to the economic system. It's just like a mechanical substitution. The other point, which is minor and it's more related to the euro area, but it's interesting as well, I think, and it's the fact that in the numbers that you see, fiscal numbers that are based on national numbers, you don't have the impact of the EU Recovery Fund, which is acting below the line. So there is an additional support that, by the way, will be long-lasting, at least for the next 5 years. And so the real fiscal cliff is smaller. But so these are just a few elements to describe the fiscal cliff. But then the key question is, yes, that savings are, in fact, if you look at them carefully, they are a delayed fiscal impact of the big fiscal boost that we had in the past 2 years. Because the reality is that the fiscal boost has not been spent. I mean, it has not been all spent during the past 2 years. So it's still there in the system with a kind of slow release of the stimulus, and that's why I was talking before about 7-8 points of disposable income available to boost consumption over the next 2 to 3 years. Relative to that, and I mentioned the euro area again, the fiscal cliff is of around 2 to 3 percentage points, including all this apparent element that I mentioned. So it's actually even smaller. So as you can see, yes, we'll be more than saved by savings.
Good to know. So thinking in the UK then, Ross, because that's one of the first major economies to actually announce a fiscal tightening measures, what impact do you think that will have? And I guess relating that to monetary policy too, what impact do you think that could have on bank rate? There's been a lot of guidance recently that rates will rise very soon, but how far do you think that they could really go?
So the UK fiscal position is a little more complicated. In aggregate, overall, the fiscal stance remains accommodative. The UK will continue to run cyclically adjusted primary deficits, 2 to 4% of GDP over the next few years. So fiscal policy is still supportive, but clearly less so than during the pandemic, when, of course, fiscal policy was deployed in a much more expansive way. The further complication, however, in the UK is it relates to specific policy measures. So, for example, households and businesses will face a material rise in taxation in the coming years. For households, there is a national insurance, in effect, an income tax rise coming in April 2022. And then a year down the line, further income tax increases. For the corporate sector, the same national insurance increase, and then a sharp rise in corporation tax in spring 2023. So for households, for businesses, for the private sector in general, the headwinds are more apparent than perhaps what was planned a year or so ago. But against that, and as we saw in the October 2021 budget, the government did announce additional provisions for higher public spending. And in the coming year, 2022, and the following year, that fiscal boost we estimate to be worth around 1% of GDP per year. So a number of moving parts on the fiscal side, but I think in aggregate, you would say there is an overall accommodative policy setting. And I think the BOE will certainly view fiscal policy in that context, and therefore this will tend to reinforce their confidence about raising interest rates, their perceived need to raise rates. And so we expect the first UK interest rate rise to come in the early part of 2022 in February. There is a risk it comes a little bit sooner in December, and for that to be the first of a series of modest rises, taking bank rates up to around 75 basis points by the end of 2022. The risks around that scenario are probably slightly to the upside if among other things, consumers were to deploy that savings stock more extensively, or if we were to see larger fiscal multipliers, that might force the BOE to deliver a little bit more by way of monetary tightening. But on our estimates, taking bank rates up to 75 basis points by the end of 2022 should be sufficient to lower inflation by just over 0.5 percentage point. In other words, to take out what we see today in terms of the overshoot in domestically generated inflation, alongside the natural unwinding of some of the energy and global cost pressures, which are evident today, which will come away with base effects over the course of next year.
What about in the US then, Kevin? Does your view on savings kind of shape how you're thinking about the potential for an earlier liftoff from the Fed?
Yeah, it does. In the fact that one of the key reasons I think that we think inflation will stay elevated, and we're going to see this persistent overshoot of the Fed's goal on the inflation side, is that demand is going to continue to exceed supply. So with all this reservoir of savings able to spend out over this substantial period, our forecast for inflation is going to probably remain closer to 3% than the Fed's estimate of going down closer to 2%. So, it does certainly add some risk to pull forward liftoff. I don't think they're, as of now, ready to really turn to, until they've finished the taper, turn to rate hikes per se. But I think at the margin, this does put some risk that the Fed could start to hike rates sometime in 22. We have it in the fourth quarter. I think the Fed's going to have to do a lot towards their communication with regard to FATE, the flexible average inflation targeting, because that was really designed at a period of below 2% inflation. And obviously inflation is well past that now. So I do think that they'll probably abandon that sort of approach and focus more on the inflation side. And that's a direct relation to how much consumption we're likely to see.
I guess a similar question to you, Gio, but perhaps we should be asking, will the ECB ever raise rates rather than are there risks of earlier rate hikes?
Yeah, I mean, the situation in terms of savings and stronger activity that we expect is clearly a driver also of higher inflation, slightly higher inflation, I would say, in the case of the euro area relative to what we're seeing in the US. I mean, the support to activity has been also smaller, and so that's one of the reasons. At the same time, we know that with the strategy review, the ECB has gone even further in this journey towards a more dovish central bank. The ECB has missed for so many years its inflation target, has changed the inflation target towards something that it's slightly higher, more symmetric, and it's a little bit still, reacting to this situation where they are very close to the effective lower bound. And so, I mean, my interpretation is that although the ECB is still, dovish for longer and more than markets are pricing, are expecting, it is also clear for the euro area that the possibility, the probability of the rate hike has moved a little bit closer. So we definitely don't see a rate hike in 2022. To be fair, not even in 2023. My first port of call will be 2024, given the underlying inflation dynamics that we expect, and given also, related to this still stronger than consensus expectation for GDP growth over the next 2 or 3 years.
All right, everyone. Thank you for joining me today. And to our listeners, I hope that you enjoyed today's special episode of On Point. To get more insight into the year ahead, navigate to ci.natwest.com/year ahead and follow us on social media, or feel free to get in touch with any of us via Bloomberg or email.